Are you charitably inclined and also frustrated by how much you're paying in taxes? Well, here's something most taxpayers don't realize. Charitable giving can be much more than just generosity. When structured correctly, it can become a powerful part of a proactive tax plan. Hi, I'm Angie. I'm on a mission to help you keep more of what you earn, grow your net worth, and make taxes less stressful for you. In today's video, I'm going to talk about three different charitable strategies and how they can work alongside a good tax plan, wealth plan, even retirement planning for that matter. The first strategy is called Donor Advised Fund, or DAF. This can be a great tool when you have a high income year, a large bonus, a stock payout, a business sale, or a major capital gain event of any sort. Instead of making small charitable donations year over year, you can bunch up several years of charitable giving into one tax year, get a large deduction, and then recommend those grants to charities over time. But here's what you need to watch out for. Once money goes into a donor advised fund, it's no longer yours. It's committed for those charitable purposes. Also, the deduction depends upon what you donate, how much income you have, and whether you can itemize deductions. The second strategy is a charitable remainder trust, or a CRT. This can be really, really powerful when someone is selling a highly appreciated asset, such as real estate, a stock, or a business interest. Instead of selling the asset directly and triggering a large capital gain, the asset may be contributed to the trust. The trust can then sell the asset, provide an income stream to you or your family, and ultimately leave the remainder to charity. When structured properly, this can help defer taxes, create a charitable deduction, and support long term income planning. But you got to realize these are not magic. You need to be very careful about timing, valuations, payout rates, and whether you're comfortable giving the remainder to charity, right? Also, if the sale is already too far along, it may be too late to properly contribute the asset before the gain is locked in. So you need to watch out for some things. The third strategy is a charitable lead trust, or a CLT. This is kind of the reverse of a CRT. With the charitable lead trust, the charity receives income for a set period of time, and then the remaining assets can pass back to the family or the taxpayer. This is really helpful to support charities, and then also get that asset back over time. But with CLTs, the details matter: interest rate, assumptions on asset growth, cash flow. All of that needs to make sense. And this is not just a simple year-end tax deduction strategy. It's more of an estate and wealth transfer planning tool and needs to be executed efficiently. Now, here is where proactive tax planning becomes even more interesting. Charitable strategies can also be coordinated with Roth conversions. A Roth conversion can be fantastic long-term wealth strategy, but it creates taxable income in the year of conversion, right? So if you layer up these strategies, that you can basically convert some deferred accounts into tax-free retirement accounts very effectively. We've helped our clients massively doing this, but you have to model all of this carefully. A Roth conversion can really push you into a higher tax bracket if you're not watching. So the question is not just, should I do a Roth conversion? The question is, how much should I convert, in which year, and what deductions or charitable strategies can I coordinate with it? The key is, these strategies should not be looked at in isolation. It should be part of an overall custom plan based on your individual situation. Now, a DAF or a CRT or a CLT, Roth conversion, can each be valuable on their own, but the real magic happens when they're coordinated together based on your individual situation. This is what proactive tax planning is all about, folks. It's not just about writing a check to charity at year end. It's about asking, how do we align your values, your wealth goals, and the tax code so your money creates the greatest impact? And most importantly, these strategies need to be planned out before the transaction happens, before year end, and before you make irreversible decisions. Hope this was helpful. If it was helpful, please like and subscribe to my channel, whichever platform you're listening on. This helps me bring advanced tax reduction strategies used by billionaires and big corporations to mainstream taxpayers and business owners like you and me.